Hello, everybody. My name is Frédéric Godin. I'm a professor at Concordia University, and the title of my presentation today is A Mixed Bond and Equity Fund Model for the Valuation of Segregated Funds Policy. This is joint work with Maciek Augustiniak from Université de Montréal and Emmanuel Hamel from Université Laval. So we're going to start with a brief introduction about segregated funds. So segregated funds or in Canada or variable annuities in the United States are hybrid insurance and investment products. So these products they typically offer either a life insurance or an annuity to some policyholder, but where the benefits are tied to the return of an underlying asset, which is typically a mutual fund. And moreover, the capital that is invested in these policies is typically protected by a set of guarantees. So this is why we see it has both an insurance component and a financial components to these products. So in the literature, multiple papers they use standalone equity indices or funds to represent the dynamics of the underlying asset of the policy. Whereas in practice, the underlying asset is typically exposed to multiple asset classes. So, for instance, it is often exposed to both equity and fixed income in practice. And moreover, the fund is exposed to basis risk, so there's a discrepancy between returns of the underlying asset fund and what would be predicted by its main risk drivers. So, for example, returns on the equity markets and movements of the term structure. So, this discrepancy is called basis risk, which is a very material risk for insurers, and it is important to take this risk in consideration in practice when modeling variable annuities. So the main contribution of our paper is to propose a model for the dynamics of a mixed bond and equity funds component where the fixed income component of the mutual fund has a dynamics that is linked to movements of the term structure. And linking the term structure and returns of the underlying asset is very important to value segregated funds or variable annuities, because when we price these guarantees, we must project the returns of the underlying asset, but we must also use the term structure to discount the payoffs provided by the guarantee. So the interplay between the term structure and the returns of the underlying fund or the mutual fund is very important to take into consideration. So the model we proposed has the form of a multi-factor asset pricing model, which parallels many works in the literature. And there's a theoretical motivation which relies for our model, which relies on an analogy with a portfolio of rolling horizon bond funds. Okay, so we use these rolling horizon bond funds to justify the specification of our model. And finally, the basis risk that was discussed earlier is very naturally incorporated to our model and the specification we proposed. So now let's describe the modeling framework that we propose for our mixed bond and equity funds dynamic. So first, we're going to assume that the market includes the following assets. So first, it includes a risk-free asset earning the risk-free rate. It includes a collection of zero coupons of different maturities. And finally, it also includes a set of stock indices. So because our underlying fund contains both fixed income and equity components, we must propose dynamics for both such components. So for the fixed income part, it's very important to propose a sound interest rate model. Okay, so here we're going to assume, or we're going to use a discrete time version of the multi-factor Vasicek model. So we're going to assume that the risk-free rate is given by the sum of p-term structure factors, and each of such factors is assumed to follow a discrete time version of the Vasicek model, which is a Gaussian model here. Okay, so the variation of the factor is some return to the average term plus a noise term that is assumed to be Gaussian. And under this model, the price of zero coupons, so P small t capital T is the times small t zero coupon price if it matures at capital T. And through a risk neutral expectation, it's easy to show that under this model, the zero coupon bond price has this form. So this model is an affine term structure model, which is very convenient to work with. So for the equity part, we assume that the equity indices on the market follow some multivariate Egarsh process. Okay, so we assume that the excess return of our index is this term, which includes lambda, which is an equity risk premium, minus some convexity correction, plus a noise term, where in the noise term, the innovation is Gaussian, and the volatility here follows, in the second equation here, an Egarsh process. Okay, so we have a multivariate Egarsh with correlated Gaussian innovations for the equity component. So finally, the last step of the specification of our model involves linking the dynamics of the underlying mutual fund to the equity and term structure models. So this is a key step in our modeling procedure. So what we want to do here is to specify the dynamics of the process of the mutual fund returns and in relation with other drivers, which are the fixed income and equity components. So how do we do that? In the literature, the mutual fund returns is typically modeled with a univariate process. So people postulate a standalone dynamics for this return, and they don't necessarily link it to term structure movements. But we feel it's very important to link the dynamics of mutual fund returns to movements of the term structure, because the fixed income component of the mutual fund will be, of course, linked to movements in the term structure. So when the term structure moves, bond prices move also, and this impacts returns of the mutual fund. So how can we propose such model? Well, let's first start with a pure equity fund. So assume for now that there's no fixed income component. How could we specify the dynamics of the mutual fund? Where the approach we use relies on some fund mapping regression relationship. So we assume that the excess return here of the mutual fund is a linear combination of returns of the various equity indices. So this is known as a fund mapping relationship, plus some noise term, where again this noise term has a volatility which is driven by an Egarsh equation. Okay, so this could be a sound model if the mutual fund was only exposed to equity risk. But now we want to extend this to consider the case where the fund is exposed not only to equity but also to fixed income. So let's say the fund includes bonds. We must take that fact into consideration also. So how can we extend the pure equity fund model to include or to represent the dynamics of a fund which is exposed to fixed income also? So our proposal in the paper is to include an additional term here, which is highlighted in blue, which consists of a linear combination of the shocks on term structure factors. Okay, so shocks here are variations up to some term here. So this constant here, it will be justified subsequently, but we can think of these terms as variations over the factors of the term structure. Okay, so this seems reasonable intuitively, but can we motivate this theoretically? And the answer is yes, so we are going to present now such theoretical motivation. So let's assume that we have a portfolio B of capital M rolling horizon bond subfunds, and each of the subfunds contain exactly a single bond which is rolled over at every period. So the bond is sold and another new bond is purchased at every period, so that the maturity of the bond in the subfund remains constant. So for the subfund J, the maturity of the bond is always tau J. So each of the subfunds contains a single bond whose maturity is constant through time. And then each of these some funds are aggregated together through some weight here, W1 to WM. So the total portfolio is a weighted combination of each subfunds. Then it can be shown that for the specification, for the model from the paper we use in the paper, the excess return of that bond fund is approximately the weighted average of excess returns on each of the subfunds. And using the multi-factor Vasicek model, this can be shown to be equal to some constant here minus some linear combination of the shocks of the term structure factor here. And here these constant here and here, they depend on W's, which are the weights of the bond funds, and the quantities A's and B's are quantities we obtained from the pricing of zero coupons in the multi-factor Vasicek model. So we can see that if the mutual fund was a rolling horizon bond fund, its return dynamics would be a particular case of the model we propose, and because it includes here the linear combinations of shocks on term structure factors. So this justifies why we include this additional term which is made of a linear combination of term structure factor variations. So this completes the specification of our model. We now applied our model to real data. So we estimated on our model on some real data, and we can now provide an overview of the fit. So the estimation of the model was made step by step. So first, the interest rate model was estimated with a Kalman filter, and from that estimated model we were able to infer values both for the short rate RT and each of the underlying factor XI. So this we can do that through standard filtering techniques, and once we have inferred values for these factors, we can estimate both the equity model and the fund model, which relies on both the equity and interest rate models, using standard maximum likelihood techniques. So we applied it on some real data. Here are the data sets we've considered in our study. So for interest rates, we used spot curves provided by the Bank of Canada, end of month yield curves. For equity indices, we've used historical returns for the S&P TSX, which is the main index in Canada, and S&P 500. And finally, for the mutual funds, we've considered three different cases. The first case, which is a broad bond fund ETF, so the iShares Core Canadian Universe Bond Index ETF. And the two others are funds on which segregated fund policies are issued. So the first one, the RBC1, is a pure bond fund, whereas the assumption Life 1 here is a mixed equity and bond fund. So having these two funds, it allowed testing our model both on pure bond funds and bond and equity funds. So for the fixed income, the interest rate portion of our model, we saw that the fit was very good. So here uh, we compared the observed spot rates both of 3 month and 10 years and compared observed spot rates to model implied spot rates. So the observations here are the dots, whereas the model implied rates are the full lines here. And we can see that both are roughly identical. So our model provided very good fit to actual spot rates from the data set. So this was very good. And for the equity part and mutual fund part, we ran a battery of statistical tests on model residuals, and these did not highlight any obvious model shortfall. Okay, so we've applied junk box test for the correlations, Lagrange multiplier test for volatility clusters, and the residual Pearson tests to test the normality of residuals, etc. And all these seem to indicate that the fit of our model was adequate for our data set. So once we fitted our model to real data, we went on applying this to the valuation of variable annuities. So we've valued some variable annuities on two different funds. These two funds were discussed earlier. The first one, the RBC one, is a pure bond fund, whereas the second one, the assumption one, is a mixed bond and equity fund. So we were able to test our model on these two types of funds. And the policy, we made several assumptions on the policy we wanted to value. So we assumed we were pricing a 20-year maturity GMMB. So a GMMB is a policy which provides a benefit if the policyholder survives until the maturity date. And we assume that this benefit was issued to a homogeneous pool of policyholders age 55. The guarantee, the GMMB guarantee, we assume it was a return of capital guarantee. But it included either no ratchets or ratchets during the first 10 years. Ratchets are provisions that can allow adjusting the guaranteed amount if the underlying fund return is very large, for example. So we tested both specifications without or with ratchets. We took the CPM 2014 mortality table to assess mortality with some mortality improvement as recommended by some working papers of the CIA, Canadian Institute of Actuaries. We've included dynamic lapses in our study, inspired from research done from the Autorité des marchés financiers, which is the regulator of insurers in the province of Quebec here in Canada. We've included also surrender penalties starting at 7% the first year and decreasing every year until they reach zero. And finally, we've included an interest rate floor at minus 0.75% because we know that in the Vesicek model, interest rates are not bounded below. So we've applied then a lower bound to the short rate in our study. So because we have limited time, we won't present exhaustively the results of the evaluation, but here are key points that stem from our analysis. So first, we saw that the cost of the guarantee represented a very small portion of insurers' cash inflows. So the inflows to the insurer are the fees charged to the policyholder for the guarantee, and we saw that the cost of guarantee, which is the present value of the benefits provided by the guarantee, was never more than 25% of the present value of inflows. So these seem to indicate that these policies would be very profitable for the insurer. A second point we saw is that the long-term return of capital guarantee on the bond fund is close to being worthless. So when we have a mixed fund, both bond and equity, the guarantee provided by the policyholder had some value, but for pure bond funds, the value of that guarantee was very limited in the context of our study. And finally, another key takeaway is that the valuation of the policies, segregated funds policies, was not very much impacted by starting volatilities of equity assets, but in contrast, the initial interest rate environment had a very substantial impact on the costs of the guarantee. So starting volatilities were not very material, starting equity volatilities, but starting values for interest rate had a very material impact on the price of segregated fund policies. So this can be explained by the fact that interest rates tend to be much more persistent than equity volatility, so they have a more substantial impact on pricing. So now we're going to conclude. In this paper, we developed a time series model to represent the dynamics of a mutual fund invested both in equity and fixed income asset classes. Our model relied on three main building blocks. First block was a affine term structure model for interest rates. The second block was a multivariate EGARCH dynamics for equity indices. And the third block was what linked the mutual fund dynamics to the dynamics of both interest rate and equity risk drivers, which was some form of EGARCH model, which relied also on a fund mapping relationship or regression, which regressed on returns of the equity indices and shocks on term structure factors. And because of the presence of the residual term in the third building block, this model naturally allowed for the integration of basis risk in the model. Our model was very important in the context of the valuation of variable annuities because we mentioned that for valuation of such products, it's very important to understand the interplay between the mutual fund returns and the term structure dynamics. And finally, we've assessed the performance of our model on some real data. So we fit the model on some real data, and with these fitted models, we applied it to the valuation of variable annuities, and we had a very important takeaway, which was that the ongoing interest rate environment is a very important input to take into consideration when valuing long-term guarantees. So that concludes our presentation. Thank you for listening.